BYD is winning. On paper, it's a powerhouse. They just rolled their 16 millionth vehicle off the line, they've surpassed Tesla in quarterly volume, and they're the only EV maker that is fully vertically integrated, making everything from the batteries to the semiconductors. So, why are short sellers swarming? In the Hong Kong market, BYD's short-selling ratio has spiked as high as 37%. How can the king of EVs have a target on its back? Today, we're looking at the 4 major cracks short sellers see in the BYD armor. First, let's talk about the leaky bucket problem. BYD's home turf in China has entered what its own CEO, Wang Chuanfu, calls a brutal knockout stage: overcapacity. China's factories can produce 55 million cars a year, but the country only buys about 23 million. That's a 50% utilization rate. The margin squeeze. To survive, BYD is slashing prices. In early 2026, average discounts reached record levels just to maintain market share. The result, even though they sell more cars, the profit per car is thinning. Short sellers are betting that trading price for volume isn't a sustainable long-term strategy for a public company's stock price. Here is a technical reason short sellers are salivating: the balance sheet. For years, BYD effectively used its massive scale to delay paying parts suppliers, using that float to fund growth. But as regulators tighten oversight on supply chain financing, that strategy is hitting a wall. Rising debt. BYD is now forced to take on more interest-bearing debt to manage its working capital. Cash flow pressure. When you combine higher debt with lower margins from price wars, the fortress balance sheet starts to look more like a standard, struggling industrial giant. Third, the global savior narrative has a catch. BYD is banking on overseas markets to save their margins. And while international sales are growing, short sellers see 2 massive risks: the tariff war. The EU and US are aggressively raising trade barriers. Building factories in Hungary or Brazil to dodge these tariffs is expensive, risky, and takes years to become profitable. Logistical strain. BYD is literally building its own fleet of cargo ships because they can't find enough capacity to export their inventory. Short sellers see this as a sign of a company overextending itself in a volatile global economy. Finally, there's the smart factor. The market is shifting from who makes the best battery to who makes the best software. Major analysts have recently flagged that BYD is having to spend billions on R&D for autonomous driving and AI-integrated cockpits just to stay relevant. Short sellers believe that as EVs become computers on wheels, BYD's manufacturing scale might actually become a liability compared to software-first competitors who don't have the overhead of massive factories. So, is BYD in trouble? Not necessarily. They have massive cash reserves and unparalleled scale. But short sellers aren't betting that BYD will fail. They're betting that the glory days of easy growth are over. They see a company facing a debt-heavy transition, a brutal price war, and a software race they haven't won yet. What do you think? Is BYD a buy-the-dip opportunity, or is the short case too strong to ignore? Let me know in the comments.